Officers Adda 247 YouTube channel. So this is another morning, this is another session where we are going to discuss some very important concepts, and based on that we are going to solve the very important questions. And today we are going to understand about the current yield of the bond and the multiple questions that may be asked in the examination from this particular topic. Okay, so let's start the session. Before to start, one update also from our side. The target batch is going to start from the 7th March, and that batch is very important if you are preparing for the JAIIB examination, because in this batch you are going to understand everything from zero to advanced level. Like first you just going to understand the basic understanding of every chapter, every topic, and after that you are just going to just understand the easy, moderate as well as the difficult level questions. And now we just know what kind of the questions that usually asked by the examiner in the previous examination. So based on that we will just provide you the latest lectures, latest questions, and I hope you should just enroll in this batch, and you just going to receive the maximum discount with the code that is Y422, and with this code you can just enroll in these batches. And I hope these kind of the batches that are very helpful in your preparation. So I hope you should just enroll in that. Okay, so now let's start. So we are going to understand about the current yield of the bond. And whenever we just talking about the current yield of the bond, like we just understand what is the bond. 1 minute. So till here what we understand, like what is the 1 minute. Let me fix this. Okay. So we understand about the bond, we understand about the face value of the bond, we understand what is the coupon rate, we understand what is the YTM, what is the yield to maturity, and based on that we have done a multiple of the questions. Okay, so now we are going to understand about very important term, that is current yield of the bond. And the multiple questions usually just seeing in the examination, that is about the current yield of the bond. So what is the current yield of the bond? That is actually measures the rate of return. That actually measures the rate of return on a bond. Okay, and if it's just purchased at its current market price. So if it's just purchased at a current market price, or say current price, so that means whatever the trading in the market. So if it is just purchased at the market price or the current price, so the measurement of the rate of return on the bond, that is known as your current yield of the bond. So if I say that if the like coupon interest that is received, and the rate of interest, like it is purchased at the current market price, so whatever the rate of return, that is known as a current yield of the bond. So in the examination, the only formula that you have to memorize for solving the questions of the current yield of the bond, that is current yield of the bond, that is equal to your annual interest earned, and it is divided by the current price, or say market price of the bond. And in the previous lecture I already explained, whenever you just find the face value of the bond, okay, and the coupon rate, the first thing that you have to do, and after that whatever the multiple of the rates are given, whatever the multiple the interest rate that's are given, suppose a required rate of return is given, okay, that doesn't matter. Only annual interest, for calculating annual interest earned, you only need two factors, that is face value of the bond and the coupon rate. So just multiply with the face value of the bond. Suppose that face value of the bond, that is 1000 rupees, and the coupon rate which is 10%. So just multiply with this and you will get the annual interest earned. And this is the first process that you always have to do. Okay, so that means if I say what will be the value, that is 100 rupees, that means annual interest earned that would receive till the maturity period. And what is the maturity period? Like if it is going to mature in the 3 years, that means for the first year the investor is going to receive 100 rupees, for the second year investor is going to receive 100 rupees, and for the third year investor is going to receive 100 rupees plus 1000 rupees. That is known as the face value of the bond. Okay. So now the question that whenever we have to solve the current yield of the bond, so what the current yield of the bond, that is actually the measurement of the rate of return. What it is actually the measurement of the rate of return on the bond if it is purchased at the current price or say market price of the bond. Okay, so now I think it is just sufficient for your preparation. Okay, the only concept that you have to understand that what is the current yield of the bond and how we just calculate the annual interest earned, and after that we are going to solve the questions based on that. Okay, so just understand. So the first question that is given, like if a bond of the face value that is given 1000 rupees and interest coupon interest rate. Look, one more thing I would just like to describe, that whenever you just going to just see like if any question that is given the coupon rate, okay, so that you have to understand that coupon is nothing but interest rate is given for your the face value of the bond, or say the value of the bond. Okay, so and the another thing that if you see just that is zero coupon rate, or say what we understand by the zero coupon bond. So zero coupon, that means zero interest. Okay, actually these kind of the bond that is just provided a discounted rate, so that means it is just for the zero interest, that's why it is named as zero coupon bond. So this is another thing, but I just want to just remind you guys, this is already I explained you. So whenever we have to just calculate the current yield of the bond, the only thing we have to do, that current yield of the bond that is equal to your annual interest earned. So annual interest on, and it is divided by the current price and market price, or say market price or say current price. So like in this question, if I say what will be the annual interest earned, that is annual interest earned by the investor. So the face value of the bond, that is 1000 rupees, and coupon rate always be apply on the face value of the bond you for just calculating the annual interest on. So this 1000 rupees that is multiplied by the 8%, so that become your what, that become your 80 rupees, right? And now if the term that is given, like maturity period and all things are given, that doesn't matter for your calculating the current yield of the bond. The only two things that required for current yield of the bond, that is face value of the bond and the coupon rate and the current market price. So what the basically, because sometimes the questions is in the form of the theoretical term, and the question that is what are the components that you actually needed for calculating the current yield of the bond. So like face value of the bond, whatever the value of the bond, and the coupon rate that would already just know, and the current price or the market price, the three things that you actually have to know for just calculating the current yield of the bond. So if I say what will be the current yield of the bond here, that is annual interest earned, that is 80 rupees, so just write here. And the current price, that is 800 rupees, so just write here. And for calculating the yield in the percentage, we just multiplied by the 100. So just solve this and tell me what will be the answer. So the answer that would be 10%. So this is how we solve these kind of the questions in the examination, and I hope it is now clear for everyone. Okay. Now just do another question. Now just do this question by your side first. After that, I will explain you how to solve this question. Just try to solve by your side first. Tell me what would be the answer here. Look, whenever the 7% coupon bond of the face value of 1000 rupees, what it exactly mean? Look, the 7% coupon bond, that means whenever you just find the coupon and the face value, that means you can easily calculate annual interest earned, right? You can easily calculate the annual interest earned, and that would be equal to your 1000 rupees and multiplied by the 7%, so that will become the 70 rupees, right? Okay. After that, the another thing that you have just required, that is it is termed that is trading at for 560 rupees. That means the market price of the bond that is given 560 rupees, isn't it? What are the different terms given here? That is 7% coupon bond is given, and the trading for the 560 rupees. That means the currently market price that is given you for the 560 rupees, and you have to just find out what will be the current yield of this bond. Okay, so we know that the formula that is current yield of the bond is nothing but the annual interest on. Look, this formula you have to memorize, that is current yield of the bond that is equal to the annual interest earned, and it is divided by the current price and the market price. So the annual interest earned that will be equal to your 70 rupees, and the current price or say market price, which is given 560. And for calculating this term in the percentage, what we exactly do, we just multiply it by the 100. So just calculate and tell me the answer. This would become the 1 by 8 or say 100 by 8, and that means the value that would be 12.5%. So the answer that would be the A. So I hope it is now clear for everyone. This would be the answer for everyone is getting. I hope everyone is just getting this answer for this question. Okay, so this is how we solve these kind of the questions. Now just attempt another one. You will exactly find the same type of the questions in the examination whenever you just find the current yield of the bond, and these kind of the questions usually asked in the examination and for the 1 marks. Okay, so that is very important. Look, the first thing that you have to do for the annual interest fund, you have to first know what is the current yield of the bond. So that would be annual interest on, and it is divided by your current price or say market price. So the annual interest on, what is the annual interest on. So if we have to calculate the annual interest on, so that would be equal to 1000 rupees, and it is multiplied by the 8%, so that would become the 80 rupees, right? Okay, so now the thing that you have to just apply just write here 80 rupees, and it is trading for 1400 rupees. That means it is trading for the premium price. Okay, so whenever any company, why it is just running at a premium rate, is trading at a premium rate, because when the companies values is more is in the market. Okay, so that means the company just issuing the face value of the bond, that is 1000, but demand for its bond is very high. Okay, so that's why it is just trading for the premium price, and that is a 1400 rupees. So just write here 1400 rupees, and it is multiplied by the 100. So this value would be become, that is 18 divided by the 4. Okay, so what would be the answer? Just tell me. That is, just tell me what would be the answer. That is 5.71%. So that would be your answer. So I hope it is now getting for everyone. That is how we can just calculate the current yield of the bond in the question. Okay, so what we exactly understand, we till here we just understand very important factors for the bond. Like we understand what is a bond, what is present value, what is the future value, and between the, we have to just understand the relationship between the present value and the future value. And the relationship, if I say what is the relationship between the present value and future value, that is your future value that is equal to present value and multiplied by 1 plus r to the power n. And trust me, this formula is very important, because in the examination you will definitely see, like on the 27th February of the accounting paper, we already see the relationship. Based on this relationship, you find the 1 to 2 questions in the exam. So this formula is very essential for understanding everything for the bond, for the capital busting questions. Okay, so this formula is very important, this formula is very essential to understand. Okay, so that is future value that is equal to present value, and it is multiplied by the 1 plus r to the power n. So I hope it is understandable for everyone. One more thing here that is important to understand. Look, I just want to just elaborate here. 1 minute, let me remove all the stuff here. Okay, one more thing that I would like to just tell you guys, that is important from the exam point of view, that bond price that is inversely proportional to your yield to maturity. Okay, again, what is yield to maturity? If I say what is yield to maturity, anybody knows what is the yield to maturity? You know, whenever we just whenever any investor, or say whenever any bond holder, look, if this is a bond, if this is a bond, and it is just purchased by the investor, okay, say investor or say bond holder, whatever you just want to say. So that is investor or say that is bond holder, and that is known as a issuer who just issue the bond. Okay, so bond that may be issued by the government, corporations. Okay, so I hope it is understandable for everyone. So what for average of this, the investor or say bond holder just going to receive the interest as well as the principal. So that is known as your bond definition, or say basic definition of the bond. Now the question that is, what is YTM? So yield to maturity, say YTM or say yield to maturity, that is the total rate of return. So whenever we just talking about your the YTM or say required rate of return or say current yield of the bond, so rate of return, okay. So YTM is nothing but the rate of return that will have been earned by the bond when it makes all interest payment and repays the original principal. So whenever the issuer just pays all the interest and look, just understand this. Whenever the issuer just pays all the interest and pays all the interest as well as the original principal, okay, that actually mean that whenever the bondholder, that bondholder or say investor just holding the bond till the maturity, either this say, or you can say that issuer or say bond issuer just pays all the interest and along with the principal. Okay, so that is known as, or say the rate of return that will earned by the bondholder or say investor. So that is known as your yield to maturity. So that yield to maturity will always be inversely proportional to the bond price. Whenever the bond price, that would be the higher. Suppose that the bond price, like we understand in this example, if I say that look, what example we understand in the previous slide. Okay, so whenever we just 1 minute for this question. Okay, so like in this question, the it is trading for 1400 rupees. So we can see that the current yield of the bond is lesser than for this. Like if we calculated for the like 7% coupon bond of the face value that is carrying the answer of this question, that is 12.5%, right? So whenever the bond price that would be the higher, that means yield to maturity that would be the lower, and that is most important feature of this. And this type of the questions is usually asked in the examination. That's why I am just highlighting this. So bond price. So whenever the bond price that would is going to higher, or say bond price that like 1,000 rupees, and this is just become 1,200. So that means the rate of or say the YTM or say yield to maturity, that would be just reduced. Okay, so if the bond value would be increased, that means YTM or say yield to maturity, that would be decreased. So you just understand the relationship between the bond and the YTM. So I hope it is now clear for everyone, right? Another thing also, we are just going to say that, like, YTM is just a total return that anticipated on a bond if the bond is just held until it matures. So it is considered as a long term bond yield. So whenever you just find the term that is YTM, that also means that it is a long term bond yield. Okay, that is known as a long-term bond deal, and but it is expressed as the annual rate. Okay, so in if I say in other words, it is the internal rate of return of an investment in a bond, of like if the investor holds the bond until its maturity with all payments made as scheduled and reinvested at the same rate. So that is known as a YTM, and that is the most important definition of the YTM. Okay, so I hope it is clear for everyone. So that's all for this session. I hope this lecture is useful for you, and if you're liking our effort, Please do not forget to hit the like button on this video, and if you are not downloaded the Adda 247 application, just download this and subscribe the Officers Adda 247 YouTube channel so that you can get the notifications of the live session as well as the notifications of the important lectures that is related to your examination. Okay, so thanks for watching me here, thanks for joining me here, and like this video if you are liking our effort, and share this video to your friends so that maximum number of our colleagues can join with us.